Hi, good morning. Thanks for having me. I think one of the issues for natural gas you mentioned there, in terms of the extent of the price decline, is that you're in a situation where, although you still have risk for next winter, over the course of the summer, given the fact that you have a constrained level of absolute storage that you can build, you're almost needing to incentivize gas to be burnt so that you don't implicitly run out of storage later in the season. And so you're just having to put pressure on the front end of that curve to both encourage more gas to be burned and also to ultimately disincentivize marginal shipments to come to Europe. And that's a dynamic that I think, if we look at our gas analysis, we'd expect that to continue through the rest of the summer. And then it's really a case of what happens in the winter where you would get risks again. But for now, the market is amply supplied in Europe.
Marcus, I just mentioned some of the feedback from analysts, which means that we could see a zero intraday on the trade in Europe at some point in the foreseeable future. I mean, last time we saw a zero or below zero on a trade was around the oil markets, which shocked most of us. Do you think that is a possibility?
It's certainly not been something that's our base case. I think what happened with oil, though, does mean that everyone has to take these kind of things more seriously than maybe they would have done in the past and dismissed them. For something like that to happen, though, you really do need a very sort of specific set or sequence of events, which ends up in a position where effectively you are having to almost, excuse me, effectively pay someone to take the gas off your hands because you don't have anywhere to store it in the really immediate future on, say, as you mentioned, an intraday basis, so that you get a very temporary and acute period of pressure where someone just has to effectively pay to get rid. I don't think that that's a base case, but you can see how those kind of scenarios could evolve in a market where, as you say, storage is constrained. That what seems frankly fairly crazy scenario can actually occur because it becomes sort of fundamentally justified on a very, very short-term basis.
Marcus, how do I want to be positioned in the energy complex going into the June OPEC Plus meeting here? There have been really mixed messages coming out of various members, and yet the talk is of something like a lean cut. Now, I'm not quite sure what that means in barrel terms, but I'd be interested in your analysis of how you should position around this meeting.
I think, given the pullback that we've seen in the last few days, as you've kind of lost expectations for additional policy cuts, and given the positioning, you start to skew from a very short-term perspective towards, I think, slightly greater risk reward on the upside. And also when we look at purely the crude balance and think about the increase in refinery runs that you're going to have through the summer, you can see how the crude market actually looks a little bit tighter. But in our view, that really would be a relatively temporary dynamic, and that actually when we look across the whole of the petroleum balance and we look through the back half of the year, and I mean, in the intro, you're talking about disappointing growth in China. I'd add to that very much disappointing growth in Europe in particular versus expectations. On the demand side, we think the overall petroleum balance doesn't look good in the second half of this year. And our base case is that you're going to have a developed market recession and China not fully offsetting that, by no means fully offsetting that, such that actually I think the idea of a sustaining rally in any of the industrial commodities is very, very challenged at the moment. You would need to see really meaningful supply losses in any of them, or a completely different demand backdrop to change that picture within the next sort of 3 to 6 months.